Hi everyone, this is Chuck Carnevale, the Chuck in the Market's Up Chuck. And our blog today is about valuation and its importance as both a predictor of long-term investment returns as well as a determinant of how much risk you're actually taking when you're actually making an investment. You know, the market, you go back to the very beginning of this chart, back in early 1990, Walmart was, roughly fairly priced at that time. It got overvalued by the spring or summer of 1993. Then we had about 3 or 4 years of it reverting to the mean. Then we hit the irrational exuberant period. It got overvalued again. And from this overvalued period here, look how many years it took it until it finally got back in value. It kind of hit it again in October of 07 and got back in value on February of 09. But the company grew earnings during this 20-year period at 15% a year. And look at the rate of return over the long period of time. It did 12.1% versus now 4.1% in the S&P over this 20-year period, and it did it because of, again, valuation and earnings growth. It was a little overvalued in the beginning, slightly undervalued at the end, which explains the difference between the 15 and the 12. But once again, the correlation between very, very clear, as this blog is trying to point out. Now, I want to focus your attention on this period right here, and I want to make a point. Walmart was clearly overvalued in the beginning of 2000. It was trading at around $69 a share. It was actually only worth, based on its normal valuation, around $19 a share. And I want you to notice how the stock went sideways for all these years since calendar year 2000. And look what valuation actually did to the rate of return for shareholders. The company during this 10-year period, we'll call it, it's actually 9 years and a couple of months, the company grew about 11.5% a year compounded. If we're a company with a $193 billion market cap, that's extraordinary growth for that period of time. But because the stock was overvalued, shareholders in Walmart during that 10-year period where the company did great, actually earned 11% a year, actually would have lost a compounded 1.7% or, almost 15% of their money. Now, they did a lot better than the market, which during the same time frame actually lost at the rate of minus 6% a year compounded, where you lost just under half your money, 45% of your money. So Walmart was clearly better, but look how much valuation had an impact. Earnings growth was great, valuation was high, and literally, there was dead money for, going on 10 years here, because even though you owned a great company that had great operating results, because you overpaid for it, your result. The Ross store is another retailer not quite obviously as big as Walmart, much smaller, but this company had almost the same growth rate as Walmart, 11.7%, but it started this same period in value and ended just slightly overvalued, and the 11.7% growth rate where you were buying the stock in value actually culminated in the 13% rate of return versus minus 6 for the market. And whether this was a better company than Walmart, they had almost the same operating results. The real difference here was, as an investor, you were able to buy this stock when it was reasonably priced. Now, to kind of conclude this blog on valuation and earnings growth, I want you to look at Oracle, and this is a classic example of tech stocks in irrational exuberant. Look how the price of Oracle has correlated to earnings growth over most of this 20-year period. It got massively overvalued in the irrational exuberant period, through 2000, before it finally reverted back to the mean, where the stock fell from over $45 a share down to $7 a share back here at its lowest, which is really, frankly, about where it belonged. But the point I want to make here is the difference between, if you bought Oracle during this irrational exuberant period, here you are going into, 8 or 9 years later, and you still are losing money on this holding because Oracle was massively overpriced during this period, and cash flows made no sense. If you'd have bought Oracle here and compared it to putting the same amount of money in a treasury bond, as we'll explain at the end of this blog, you would have actually ended up getting 2.5 times more money out of a treasury bond than your best expectation of Oracle, which shows how upside down, this investment. In contrast, if you look at a company like Cognizant Technologies, where it's had tremendous growth over its 11-year history, this is a spinoff from Dun & Bradstreet, you can see the stock price correlated until we hit the fear-based, collapse in 2008. The stock would normally today be trading at 60. It's trading at 19, and the company has no debt on the balance sheet, generates an enormous amount of cash, and even at these discounted levels, look at the rate of return that this company would have generated versus the market, over a 30% rate of return, and that's measuring at these low valuations because of the extraordinary earnings growth. But the point is, buying it today at these low valuations, it should be very logical to expect a very quick recovery on this stock for the following reason. just approximately a 50% drop in its price, even though its earnings have continued to grow. And it actually happened one other time, which was during the last recession in 2001. Cognizant in that period of time had a very similar experience. Their stock price fell from around $3.60 a share down to $1.80 a share, very similar to what it's done today, but earnings continued to grow, and over the course of the next 3 years, the stock went from $1.86 and closed up to $11.40. You can call that 5.5 to 6 times, the amount of money from the low, but even from its original good fair value, the stock almost, did 2.5 to 3 times its rate of return, which is an extraordinary rate of return for a couple of years. Valuation really matters, and I hope this blog has helped show you how important it really is. And this is Chuck Carnevale saying goodbye, and I can't wait to do my next blog and share some other exciting investment ideas with you.